What if I told you there's a simple, powerful rule that legendary investor Warren Buffett uses, a rule that can transform the way you think about investing forever? It's called the margin of safety, and today we're going to break it down in a way that's super easy to understand, no finance degree required. So, what is this magic rule? Imagine you're buying a bridge. Before you put down any money, you'd want to know how much weight it can actually hold, right? Let's say engineers tell you the bridge can safely handle 10,000 tons. Now, would you regularly drive 10,000-ton trucks over it? Of course not. That's pushing it to the absolute limit. A smart bridge owner would set a rule: no trucks over 7,000 tons. That 3,000-ton difference, that buffer, is your margin of safety. It protects you from unexpected problems, miscalculations, or just plain bad luck. Investing works the same way. The bridge is a company, and the weight it can hold is its true underlying value, what we call its intrinsic value. The trucks driving over it? That's the price you pay for the company's stock. The legendary investor Benjamin Graham, Buffett's mentor, taught that you should never pay the full intrinsic value for a stock. Instead, you buy it at a significant discount. That discount is your margin of safety. Let's make this real. Say you do your homework on a solid company, Awesome Widgets Inc. You analyze its earnings, its assets, its future prospects, and you calculate that its intrinsic value is about $100 per share. This is what you believe the company is genuinely worth. Now, the market is a wild place. One day, everyone's scared, and the stock price for Awesome Widgets drops to $60 per share. This is where the margin of safety kicks in. You've estimated the stock is worth $100, but you can buy it for just $60. That $40 difference is your beautiful protective cushion. Why is this so crucial? Because we're all human. Our calculations might be a little off. Maybe we were too optimistic about future sales. Or perhaps an unexpected event happens that hurts the company. With that $40 buffer, a lot can go wrong, and you can still come out ahead. If the stock only recovers to $80, you still made a profit. If it goes back to its true value of $100, you've made a fantastic return. The margin of safety gives you room for error. So, how do you find this intrinsic value? It's part art, part science. You can look at a company's assets, its cash, buildings, and inventory, and subtract its debts. This gives you its book value, a good starting point. You can also look at its earnings power. A stable company that consistently makes a profit is like a money machine. You can estimate its future earnings and discount them back to today's value. Don't worry about getting the exact number. The key isn't to be precise to the penny, but to be generally right. The goal is to buy a business for so much less than you think it's worth that you don't need to be a genius to make money. Buying with a margin of safety is the ultimate defense in investing. It protects your downside. When the market panics and sells off great companies at bargain prices, that's not a time for fear. It's a time for opportunity. You're not just buying a stock ticker. You're buying a piece of a real business at a price that makes sense. It shifts your mindset from a speculator guessing which way the price will go to a business owner patiently waiting for the value to be recognized. This single principle is the cornerstone of value investing. It's about being disciplined, patient, and thinking for yourself. It's not about chasing hot trends or getting rich quick. It's about getting rich slowly, and more importantly, staying rich by protecting your capital. So next time you're looking to invest, don't just ask, will this stock go up? Ask, am I buying this with a sufficient margin of safety? That simple question can make all the difference. Thanks for watching today. If you found this helpful, give this video a like and hit that subscribe button for more simple breakdowns of powerful investing ideas. See you in the next one.